Hi, it's John Mousseau, CEO of Cumberland Advisors and Director of Fixed Income. It is Friday, April 22nd. Another tough week in bonds. This time you saw the damage come in the front end with the 2-year Treasury note rising 27 bips to a 272. Longer end a little better behaved. 10-year bond up 7 basis points to a 292. 30-year bond up 2 basis points to a 294. I think what's interesting is that in the middle of the week we saw the 10-year Treasury bond touch 3% and then go through a pretty good rally on Wednesday, and then of course settled back down again. The market has started to see that the Fed is serious about boosting short-term rates. From Jay Powell's talk this week, the market is really now counting on a 50 basis point hike in the Fed funds target rate next May 4th, which is in a couple of weeks. So this is all feeding back into the market. Munis continue to be very cheap. We're still trying to embrace the 4% yield level you've heard me talk about before. That is going to continue to come to market. We think at a 635 taxable equivalent, some of that has to be captured now. Doesn't mean the market gets cheaper. Very, very hard to shoot the quarter out of the air. You have to be a little early to markets to capture some of this, because we know that when inflation does start to slow down, and we do believe that happens either later this spring or this summer, where monthly numbers start to either not go up as much or actually start to fall, the bond market should start to react. What does it mean longer term? Does inflation go back down from the elevated levels now back to the 2% pre-COVID levels? No. But it probably settles in at somewhere 3 to 4. Will that be the new 2? Maybe for a while. What's important is the fact that we're capturing yields that are 200 basis points higher than they were just 4 or 5 months ago. And the fact is that we know that issuers are now not in the driver's seat like they were all of last year. Now they are trying to basically get to market and try to get deals done, and they will err on the side of being cheaper, and we want to capture that for our clients. So we want everybody to have a nice weekend, and we'll see you next week.
Hi, Matt McAleer, Director of Equity Strategies, Cumberland Advisors, April 22nd. Working our way through April rather quickly. An old quote or saying on trading desks and on Wall Street, and many of you may have heard of it, came to mind today, and I'll try to give the cleanest version I can of that. And that is, when the cops raid a house of ill repute, they take away the piano player also. And the thought there is, when markets get very ugly, even the stocks on the equity side that have been performing well, being defensive, maybe trading near 52-week highs, they get taken out too. And you really saw that the last couple of days. What that means in terms of going forward is you have some setups in strong sectors and industries that we can deploy some cash into. For example, we've been pretty consistent in saying that you didn't want to chase this market. You wanted to let it come to you. When there's overhead resistance, it's very difficult to chase markets. So that little rip in late March into April, we didn't really get involved. Now that the market has come back, and when I say market, let's talk about the indices, the S&P 500, whether it's cap weighted or equal weighted, mid caps, small caps. They've all pulled back to just above those lows in Q1. Multiple lows. So we're right back to where we were 4, 6, 8, 10 weeks ago. Now we have some capital. In our US ETF portfolio, we're sitting at about 13-14% cash. Remember last week we had raised some cash in the financials. So some of the areas that have pulled back and look attractive, and I jotted a few down, are in the aerospace and defense. 52-week highs last week. Hit a little bit this week. Let's not forget about commodity-linked areas, metals and miners, whether that's industrial metals and miners or precious metals and miners. Those types of names that were pressing on 52-week highs just 5 and 6 trading sessions ago have had a pretty good pullback, and that's both domestically and internationally. So in terms of our US ETF portfolio, about 13-14% cash. Tactical trend, a little more. We're in the model weight on that is 19% cash. Now, some clients that are, for example, on distribution from IRA may be below that. Some may be just above it. But that's a good slug of cash to work with. Some of those same areas are where I'll be looking to deploy in tactical trend. International. Earlier this week, we lowered our Japan allocation. Lowered that to 5%, raised some cash. That Japan indice has just been a struggle for a couple of years now, and thought the money would be deployed in a more reasonable level on global metals and miners. That's a trade we did today. PIC, P-I-C-K, has had a heck of a run for us, but it was a small position. It was only a 3% position. Had a nice run and has pulled back 6, 7, 8% in 2 days. We added to that today. So what we like to do when markets get fast is pay attention to sectors and industries and indices that have been working and are now under pressure. We don't automatically want to go to the areas that have been crushed. We want to also pay attention to areas that have done very well and now are giving us an opening. So you still want to be barbelling. Your value holdings coming into this week, we're trading within a whisper of year-to-date highs. Now they've pulled back. So we want to try to utilize some of this capital we've sat on, some of this cash we've sat on, to get into names that are giving us a little opening. Many of them will be add-ons to positions we already hold that are working. So in terms of next week, we often say the markets are exciting and are at a very important point. We really need to stress that now, because we pulled back right above multiple lows of Q1. Important to see demand come back in. If it doesn't come in, that's fine. We have to be flexible. May have to raise some cash. Remember, you're never locked in to any specific way of thinking in your portfolio. When you get locked in, when you get dug into what you think is going to happen, that's when you can get hurt the worst. So stay flexible. Look for opportunities. Don't look just in areas that have been crushed. And when we think about that, it's growth, tech, consumer cyclical. Sure, there's some opportunities there, but there's also opportunities in some areas that have traded very well and have now pulled back. We want to be barbelling there. We talk about that on bonds an awful lot, but you want to be barbelling your portfolio with growth and value. It's been a consistent theme, and we've been trying to keep that in mind on the trading desk. Next week, on April 27th, we have a Ukraine-Russia summit at USF where we're going to be discussing some of the ramifications to the markets of the war in Ukraine. And we have some guest speakers coming in. We're going to have a link on this video where you can register. If you're local, you can come by in person. It's at the Selby Auditorium at USF Sarasota. And if you'd like to watch by video, you can register as well and watch from the comfort of your home or office. If you have any questions on that, please reach out to us. So don't forget to like, comment, and subscribe. We'll try to answer any questions we get, either on the YouTube video directly or by email. Have a great weekend. Strap in. As I said a couple weeks ago, helmets on.